have here, because last class a little bit we discussed only a few introduction parts only. So now I'm going to proceed do that one again. Okay, discuss this one again. So hopefully that you have with you the example for A. Going to look at that if we have time. If not, we're going to bring for the next class. But make sure that you have the notes for example for A. That one will help you to understand the upstream sales and downstream sales in your notes. Okay, so going to stop. Going to start the class. Okay, another two of your friends later on they can join the class. Okay. Okay, at the end of the class, I'm going to share again the attendance. Okay, so I'm going to stop this one. So I just want to record this one for a while. Okay, so ready with your note. Hopefully that you already go through the things that you have in that notes. So try to understand parts of that one. So I'm going to stop sharing your attendance. I'm going to proceed with your notes. What do you have now with you? Is it the notes or the attendance? Which one that you have with you now? Sorry?
Notes.
Notes. Why I can't see the notes here? I still have the attendance here. I don't know what happened here. Wait, just want to minimize this one. Okay, so now I'm going to look at the notes here. Okay. I'm going to start from the beginning. Not from the beginning. Okay, start. Okay, if you have anything to discuss, because I can't see a parts of your chat here, because you need some space here, please voice out, unmute your mic, because maybe I missed some of the things that you have in the chat box. Okay, so we're going to proceed with this one, the intercompany transactions. We have done the bits here, so we're going to look at for the intercompany here, we're going to look at the consolidation. Nice weapon. Okay, we are going to have consolidations. Okay, subsequent means that after the acquisition states. After the acquisition state, we're going to have transactions between parent and subsidiary. So that one we call as a intra-group transactions. Okay, so the learning objective here. So we're going to look at the differentiate. We need to differentiate between pre-acquisition and post-acquisition reserve, because we're going to have two types of reserve here. That one is a pre means that at the acquisition state. Okay, and then post here is after the acquisition state. Okay, to understand the general principle of accounting for intra-group transaction, parent and subsidiary transactions, to determine the unrealized profit. So we're going to create the unrealized profit when there is a intra-group transaction. Prepare a consolidation subsequent to the dates of the acquisition. We're going to prepare for under the consideration subsequent. Okay, we have few types here. Consideration journal entry and related adjustments and elimination. You're going to prepare. First one is consolidated journal entry, and then the second one is journal entry that relate with the eliminations and the adjustments. And then prepare a consideration worksheet. Worksheet is not necessary or not required for the exam, but in the for the purpose to understand this topic, the flow of the transactions here, we need to prepare a worksheet, because from the worksheet, then we're going to prepare a financial statement. So financial statement or the profit or loss, changes in equity and statements of financial position. So data from worksheet we're going to use to prepare for the financial statements. Okay, the first one we look at the pre and post acquisition reserve. For pre acquisition reserve is a reserve that exists in the subsidiary on the dates of the acquisitions, the acquisition date. So this reserve is not distributable by parent, means that the parent is not entitled for that reserve. Yeah, entitled for the reserve. So means that the parent need to be eliminate this reserve. Yeah, because this reserve is already exist before parents bought that subsidiary, so they're not entitled for that one. So means that it's need to eliminate. So going to eliminate next year, going to eliminate against the COI, cost of investments. Okay, so and then the post-acquisition reserve here is any reserve that exists after the acquisition date. Going to exist after the acquisition date. And then the one that you have in the included this reserve should be included in the consolidated reserve. So example for the post-acquisition reserve here is a profit. Post-acquisition profit that are made by a subsidiary after the acquisition date. So any profit that are made by such subsidiary, parents are entitled. So parents are entitled for this profit. For profit, profit after acquisition. Okay. Not only parent, if you have the NCI also entitled for this profit. Okay, another post-acquisitions reserve here is related with the revaluation asset. Okay, foreign exchange reserve and then fair value reserve. This one you're going to learn in topic 5 here, topic 5. Okay, so in reserve here, we have few types here. Going to have a profit. Okay, maybe your RE here, profit. From a profit, it become your RE here. Okay, and then you have revaluation asset and then forex. Okay, and then fair value reserve, about the investments here. So we have 4 types that are under post acquisition reserve. Profit or returns earning, because from the current profit it's going to be transferred to the returns earning, and then revaluation of asset, forex, and then fair value reserve. Okay, so the procedure, so you have to be careful. Please remember this for procedure. Okay, can I just close this one, your chat box? If you have any question, please, what's up there? I can see some of the notes here. Okay, so we're going to look at the procedure. So for the considerations procedure, the carrying amount of parent investment in subsidiary and parent shares of equity, which is a shares capital and pre-acquisition reserve of the subsidiary are eliminated. So the first thing that we need to do for the considerations here, the first one, we need to eliminate COI. Eliminate COI. So it said that once you eliminate COI is exists at the acquisition state, acquisition date. So once you want to eliminate the COI, so you're going to offset this one with the shares of equity, which is a capital. Okay, shares capital and reserve. Reserve here, all that 4 types of reserve. Okay, any of that one, which is a pre-acquisition. So this is the first journal entry to eliminate the COI. So the amount that you're going to use here is based on the amount at the acquisition date, because we want to close our COI. So you're going to use the figures that you have here will be based on the figure at the acquisition date. This one is for appearance. Okay, the second time that you need to do here is to eliminate the intra-group transaction. The intra-group transactions here, including the balance and transaction. And then once they have an intra-group transaction, they may create unrealized profit. What we call this one as unrealized profit, because the profit here is around the groups here between parents and subsidiaries. So we're going to eliminate the intra-group transaction, including the balance and the transaction, balance and also transaction, and also the unrealized profit. So for intra-group, we have 2 types, balance plus transactions, and also the other one is unrealized profit. Okay, and then the third procedure here, we need to account for the portion of NCI in the current year profit and also the net asset of the subsidiary. So the third one is for the NCI. So NCI have 2 channel entry or 2 things that we need to recognize for the NCI. First one is a current year profit. Current year profit and the share of net assets. So 2 journal entries going to be prepared for the NCI. Okay, and then the next one, from this one, the last one, we're going to prepare the statements of profit or loss and others comprehensive income and statements of financial positions of parent and subsidiary going to combine line by line. So financial statements of parent add together with the financial statement with the subsidiaries, and then line by line. Line by line, for example, revenue in the parent should add together with the revenue in subsidiary and then become total revenue. Okay, so this is what I mean by line by line. The same items in parent and subsidiary account going to add together. So we have 4 procedures. Okay, the eliminate the COI, eliminate the intra-group transaction, recognize for the NCI, and prepare the statements of financial positions. The eliminations of the account or transactions are only for the purpose of preparing consolidated financial statement. We eliminate here is only for prepare the consolidated financial statement. Thus, it will not affect the parent and subsidiary. So remember that in the financial statements, you're going to have a group and you have going to have a company. So this one does not affect the company sections, does not affect, it's only affect the group because the eliminations here only affect the group. It does not affect the company. The company. So the information about the company will not affect by the eliminations. Okay, we don't have to do elimination for the company. We only do eliminations here for the purpose of preparing a group's accounts. So again, so we try to look at example 1 here. So example 1 here is related with the acquisitions, I think pre and post acquisitions we have here. Okay, so Maju acquired 100%, okay, 100% of the issued shares capital on 30 of June 2018 means that in this case there is no NCI because the parents only have 100%. Okay, for the total considerations of 120 on that date, Jaya net asset and value represented net asset at fair value presented by shares capital of 100 and return profit of 20. So altogether the equities here or the net asset which is equal to the equity here is equals to 100 plus 20, which is 120. And then the COI also at 120 means that in this case there is no goodwill. Okay. So the statements of financial position on 30 of June 2019 means that this one is after the acquisition date because the acquisition date was on 30 of June 2018. So this is what you have. Okay, so if you look at here, the investments here, once you have the investment in Jaya here, investment in subsidiary means that the accounts was prepared. This account was prepared after acquisition date. Okay, once you have the word investments here, means that this account is after the acquisition date. Okay, so the years here is 2019. 2019 is already after the acquisition state. So this is another key to decide whether this one is acquisition date or after the acquisition date. You look at the amount of the account, investment account. If there is amount for the investment account, means that this financial statement was prepared after the acquisition dates. Okay, so investment here 120. Okay, the debtors and so on, the shares capitals. Okay, now in the year you acquired this one in the year 2018. When you acquired here, the shares capital is 100,000, so means that there is no changes here. And then the return profit during that date, the return profit here is only 20,000, means that there is an increase in 30,000. So increase in a return profit. So this one is considered as a increase in your post acquisition reserve because RE is a part of your reserve. Okay. So now we need to determine the pre and post acquisition and then prepare journal entry and then prepare the worksheets. Okay, so this is what we have. So returns earning that you have here is in the year 2019, information 2019. Your RE here is 50,000. The pre-acquisition, want to decide the pre-acquisition here, 2018 here is given here is 20,000 because you acquire 100%, 20,000 here. So means that the post-acquisition reserve here is a difference between 2019 minus 2018. So you're going to have here is 30,000. That 30,000 is considered as a post-acquisition reserve. This pre-acquisition reserve need to be eliminated. Okay, and this post-acquisition reserve here, parents have a shares. Shares. Parents, it's not necessarily parents, parent and NCI. In this case, it's only a parent because you acquire 100%. So the post-acquisition reserve is entitled by both parent and NCI. Okay, so this is what you have. Okay, so proceed. Okay, we're going to proceed here. If you have anything, please, voice out. I cannot see some of the things that you put in chat box here. Okay, the first one, we're going to prepare the journal entry. So the journal entries here is to record for the eliminations of the COI. So elimination, remember that to eliminate the COI here, we need to use the value at or the figures or the amount at the acquisition state. Because the COI was exists at the acquisition state. Because the COI is only at the acquisition date. So all the value that you have here should be at acquisition date. Acquisition state. Okay, so investments here, eliminate here to debit your credit your investment 120, shares capital 100, return profit 20. Okay, now we're going to prepare the worksheet. So remember that from this journal entry, we're going to prepare a worksheet, shares capitals, and then you have the RE, RE, and then COI, 120, 120. Okay, now we're going to look at the consolidated worksheet. So the worksheets here, you're going to list down all the informations that you have in the financial statement of the both Maju and Jaya, the parent and subsidiaries here. And then we add another columns here. The columns here, we're going to have an adjustment column. Okay, adjustment column, we're going to have debit and credit. And then the last columns here is a consolidated balance. So balance here is a combination between parent and subsidiary. And then you're going to have plus or minus the adjustment. Yeah. Okay. So this is what you have. Okay, if you look at the first one, you have a land. So land you just add together. There is no journal entry related with the land. Okay, for the investment in Jaya. So investment in Jaya, if you look at here, you have the journal entry that involve the credit COI or investment in Jaya. So when you have a credit side here, you put it under credit column. Put it under credit columns here. So the investment here is in the debit side. But this one you have a credit, so debit plus a credit side, you're going to have a zero balance. Okay, you're going to have a zero balance here. Okay, and then debtor, there is no journal entry related with the debtor, just add together, bank also add together. Okay, shares capitals, going to add together, but this time we have a shares capital debit. So debit side, put it under debit side. So this one, shares capital is a credit balance. This account has a credit balance. Most of this one becomes 600. But you have a debit here 100, so means that you need to minus 100. So it means the balance become 500. Okay, the return profit also we have from the journal entry. Return profit has a debit side of 20. So add together here, you're going to have 250. This one is a credit balance, so you need to minus 20 because this one has a debit. Yeah, so we're going to minus 20. Make the balance become 250. Long-term loans add together, so you have 50 here. Creditor also add together, then you have 130. So this is what we said by add together line by line, combine together line by line. Yeah. So since your journal entries only affect the COI credit side, shares capital debit side, RE debit side, so remains the balance that we have here. Okay, from this balance sheet, if you look at here, the information that you have here is information for a statements of financial position. So we're going to use this information to prepare for a statements of financial position. Yeah? Okay, so in the statements of financial position, remember that you need to put the word consolidated. So consolidated means that on combination between parent and subsidiaries. Okay, so this figure come from console balance. Okay, so based on the worksheet that we have previously, from this worksheet, we're going to prepare a statement. The balance that we have here, just total up the lands that you have 550, investment becomes zero, debtor, bank altogether, this one. Okay, the Equities here, shares capital 500, return profit 230. So means that the use of the worksheets here is to do the adjustment. Okay, for the adjustment from the balance, the console balance here, we're going to transfer to the financial statement. It depends on what information that you have here. If that information is related with your segments of financial position, you're going to prepare a statement financial position. If information relate with the income segment, then you're going to prepare the profit or loss accounts. Is it okay with this one, the worksheets here? Okay, any of you have a questions regarding the worksheets here? Okay, data from the worksheet. Okay, balance from the worksheets here, we're going to transfer to the statement, financial statement. Okay, any questions that you have here? Any of you have a questions? Okay, so we proceed. We'll proceed with the next one. Since there is no question, we're going to proceed with the post-acquisitions profit. Okay, so this is what you have. Okay, suppose that in the procedure that we have here, the first procedure here, we're going to look at the eliminations. Okay, eliminate COI. Okay, the second procedure, we're going to look at the intra-group. Okay, and then the third procedure, we're going to look at to the NCI. So this one, okay, we're going to skip this one for a while. Okay, we're going to skip this one for a while. We're going to look at this NCI. Okay, so for the post-acquisition profit for the NCI here, because we assume that there is no intergroup transaction. So if there is any profit, okay, post-acquisition profit for the NCI here, you need to be proportionate based on the percentage of NCI. In the case when you have this NCI, so the NCI is entitled for the profit of the subsidiaries. So how much of the profit here depend on the percentage of the NCL. So it said that include in the consolidated statement. CS here is consolidated statement. P&L here is profit and loss. Okay, so in the statements of financial profit or loss, there is element or portion for the NCI. So how much the portion from the NCI is here? We need to look at the amount of the NCI, the percentage of NCI, time with profit after tax of the subsidiaries. Okay, let's say parents have 80%. So another 20% is the NCI. So NCI entitled 20% from the net income from the subsidiary or profit after tax of the subsidiary. And then we assume that if there is no intragroup transaction, because we want to skip this one for a while, there's a lot of explanation about this one. So we try to skip this one for a while. Okay, assume that there is no intragroup transaction. So we need to transfer from the income segment. Okay, because the NCI here, NCI shares a profit. So the profit from the income segment, okay, profit in the income segment, we're going to transfer to the statements of financial positions. Okay, financial position. So that's why we're going to have here debit, NCI, okay, statements of profit or loss, and then also credit NCI, but this time using statements of financial positions. We're going to transfer that profit from income statement to the statements of financial position. This one is to record the NCI shares of profit for the year in subsidiaries. Okay, so NCI entitled, parent also entitled from the profit, and NCI also entitled from the profit in the subsidiaries. Okay, so we proceed with this one. Okay, the next one. Okay, same examples. We're going to look at the examples now, but this time we have here is Maju acquired 80% interest in Jaya. So Maju and Jaya here. Okay, 80%. So means that another 20% here owns by NCI. NCI have 20%. And then Maju paid 32,000. Okay, at the dates of the acquisition, the net asset represented by the equity, the net asset represented by equity, because you know that the net asset is equals to the equity. So we have here the equity they have here in Jaya here. Shares capital 20, returns profit or returns earning 10, and then revaluation reserve 10. So this is a pre-acquisition. Okay, the pre-acquisition asset. Okay, this is a financial statements. This one is in the year 2018, 2018. And then this is a financial statement a year after that. A year after that, you have shares capitals 20. And this one is already 2019. In the year 2018, shares capital is 20, since there is no changes here. Revaluation reserve, we have 10. And then the profit RE, we have 10. Okay, so this amount that we have here, so there's no changes here, but this one there is an increase by 5, and then this is an increase by 25. So this one is your reserve. This one, all if this one is a reserve. So there is an increase in reserve. Okay, in the revaluation reserve and returns and the investments here will be 32. This one will be 0. Okay, others asset. This is what you have here. Okay, now this is the statements of financial position, and then this one is statements of the profit or loss. Okay, so you have here altogether profit for the year here is 25. Okay, plus beginning RE. Yeah, RE on 1st of January means that RE in the year 2018 become beginning RE in the year 2019. So you add together here. There is no dividend, so we're going to have returns earning, ending balance. This one is beginning balance. This one is ending balance. Ending balance RE here become 35. Okay, we assume that there is no intergroup transactions occur. So this is what you have. The profit for the years here, 25. From that 25, both parents and NCI entitled for this profit. Okay, they are entitled for this profit, for the current year profit, because the profit here is a profit after the acquisitions. Okay. Now we're going to prepare the journal entry. Okay, the first journal entries here is to eliminate the investment in subsidiaries. So this one is the COI. COI by parents. This one. Every year you need to prepare the same journal entry for parents. We're going to repeat this journal entry in the year 2008. 19, 2020, 2021, the same journal entry, because the procedure said that the first one we need to eliminate the COI. So this is the first procedure. We need to follow the procedure of consideration, eliminate the investment. So investment is COI here. COI by parents here is at acquisition state. So you need to look at how much the amount that he paid. So the parent paid 32,000. Okay, from that 32,000, parent have a shares of 80%. So 80% from the shares capital. Share capital is 20. Reserve is 10. And then RE is also 10. If you look at here, this information is only, or this figure is at acquisition date. So this is what you have for parents. So every time, every year, when you start with the consolidation, you're going to prepare this journal entry, the same journal entry for every year, because the procedure for the consolidation, you need to, the first one is to eliminate the COI. Yeah. So the second one, we're going to find how much the portions of the NCI shares in the current year profit. Yeah. Okay, so the portions, the first one, the second one, we need to look at for the NCI. But post that, the first one is COI. The second one is intra-group, but we don't have this one yet. So the third one is NCI. Okay, for NCI here, remember that NCI have two types here, two shares here. The first one is a share of a current year profit. Okay, the second one is a share of net asset. Okay, so this is the first journal entry set to record for a current year profit. So profit reported by the Jayas here, by the subsidiaries here, is 25,000. That 25,000 is a current year profit. So from that 25,000, NCI entitled for 20%, because NCI has a shares 20%. So NCI, debit NCI, but the account that we use here is profit and loss, because you want to transfer from profit profit, we're going to transfer from income statement to statement of financial position. So debit NCI, profit or loss, credit NCI, financial position. Please, when you put the names of the account, make sure that you have this one. The consolidated financial statement, profit and loss, consolidated financial statement, financial position means that we're going to transfer the income from income statements to the financial position. So the portions for NCI here is only 20%. So 20% time with 25,000 is the amount of the profit for the year. So you have here 5,000 here is a portion for the NCI. If you remember that, the total amount of profit that you have here is 25,000. Okay, from that 25,000, NCI portions here is 5,000. Based on this calculation, yeah. Okay, means that the parents' portions here will be 20,000. Yeah. So this is the first one to record for the current share profit, and then the second one is to record for the net asset, NCI net asset. So NCI net asset, the shares capital is remain at 20,000. So time with 20%. Reserve now become 15,000. So time 20% time with 15,000. Okay, returns earning that we use here is a return earning brought forward. Yeah, brought forward or beginning balance 10,000. Why we are using this one is 10,000? Why we don't we use 35,000? Because we already recognize here for the profit. Remember that? Your RE here, beginning balance, you have 10. The ending balance here, you have 35. Because of the profit that you have here is 25. Okay, the profit here is already account using this one. So the one that we should not yet account here is this amount. So this is what we have here. Okay, please make sure that you understand why returns earning here using 10,000, but reserve we are using 15,000 here. 15,000 here is to record from the total reserve that you have for a currency. Except for returns earning, return earning should use a beginning balance. Reserve should use a current one. Okay, current amount. So altogether, NCI financial positions here will be 9,000. Okay. So any question with this one before we proceed with the worksheets here? Okay, so remember that. So for NCI, we have two things, and the currency profit and also the net asset. Okay, so the net assets here is the shares capital including other reserve, but for the returns earning, because the profit for the year is already recognized in the first journal entry, so the return earning should use the returns earning brought forward. Yeah? Okay. The beginning balance of the RE. So any question for this one? Any of you have a question? So we proceed. Proceed to the next one for the worksheet. If you have a question, sit down. Okay. So now we're going to prepare the worksheet here. So worksheet, the first one, we start with the income statement. So income statement, the profit for the periods here, for all profit before tax, we just add together between parent and subsidiary. So we have 80. The tax here also add together 35. Okay, so profit for the periods here will be 45 or 80 minus 35. So you have 45. Okay, from 45, okay, this 45 you need to allocate between parent and subsidiary. Okay, so for parents here, 45 here, you're going to have here 45 time with, okay, you have here 45, you're going to allocate between parent and subsidiary. So for subsidiary, we already calculate here. Remember that the journal entry, NCI, profit or loss, credit, NCI, PNL. PNL, sorry. Financial position. Okay, 5,000, 5,000. So this one where you have debits here. Debits here, 5,000. So 5,000 here. So the total amount of 45. Since we already prepared the journal entries here, we allocate to subsidiary 5. So means that to parents we have another 40,000. Okay, another way to calculate this one. Okay, the parents beginning balance here is 20. Beginning balance here, parents beginning balance is 20. And then plus another 20 here is from 25. Okay, the subsidiaries net profit. Yeah. shares of subsidiary net profit. So 25,000 here is a subsidiary net profit. Time with the parent portion here is 80%. So you're going to have 20,000. This one is a subsidiary profit. Shares of subsidiary. Okay. So 20 plus 20. So you're going to have 40,000 for parent. So another way, because you already calculate this one, 5,000. So just 45 minus 5 here. Another way. If you don't want to calculate like this one, we just use this one. The amount of the profit minus the portion for the NCI. Sorry, this is not sorry, portion for the NCI. So you're going to have 5. So means that the parents going to have another 40. Yeah. Okay. Any question for the income statements? Okay, we just proceed for the statements of financial position. And we just start with this one. Yeah. Just okay, so now we're going to have a balance sheet. Okay, investment. Remember that the journal entry, just want to put it in journal entry once again here. Okay, the first one we have shares capital. We have revaluation reserve. Okay, and then you have RE here. So 16. This one is for parents, yeah. 8, COI 32. Okay, the second journal entry for NCI, we have the NCI income segment or profit or loss. Profit or loss, NCI financial position. Okay, 5. Okay, the third journal entry, we have the NCI. Sorry, we're going to have shares capital, revaluation reserve, RE, and then we're going to have NCI financial positions. Okay, so going to have here for shares capital 4, this one 3, this one is 2, and then we're going to have 9. So this is the journal entry. Okay, from the journal entry, we're going to transfer into the worksheet here, worksheet that we have here. Okay, the first one is your investments here. Investment 32, we already eliminate, put it under. Okay. Wait. This I cut this one. Okay, so from the comments here. So again, the one that we have here. Okay, I think I already. Oh, okay, sorry. Okay, so we're going to have here the journal entry. We're going to have shares capitals, and then you're going to have the revaluation reserve, and then you're going to have the returns earning, and then COI. Okay, so you're going to have here is 32. RE here will be 8, 16. And then for NCI, we're going to have the NCI P&L, NCI financial position 5 here. Okay, and then the third one. Okay, the third one we're going to have the shares capital or reversion reserve RE, and then we're going to have NCI financial positions. Okay, share capital 4. This one we have 3, this one we have 2, and then this one is 9. Okay, now we're going to look at here. The first one is the eliminations of the COI. So this one is a credit side, put it under credit side. So debit and credit become 0. Others asset just total up together. Shares capitals here you have 50 plus 20. But if you look at here, shares capital for parents you have 16. And then shares capital for NCI here you have 4. So this one is for NCI. So altogether 70 minus 20, so you're going to have 50. Revaluation reserve, you add together here, becomes 65. So add together here, look at revaluation reserve, you have for parents 8, and then for NCI here is 3. Okay, so you're going to have 65 minus 11, so you're going to have 54 here. Okay, returns earnings, so you're going to have 95, add together. So returns earnings, so you have 8 from parents. Okay, and then you have 5 here, 5 from NCI. Okay, 5 from NCI. Okay, this one that you have here, profit here is the NCI here. It's a profit. We have NCI. Okay, and then another 2 here from here. Okay, NCI. We put this one from NCI. So we're going to minus 15, so it become 80 here. Okay, so the NCI here, NCI financial positions, credit side, you have 5 from journal entry number 2, and then 9 here is from journal entry number 3. So you have 14 altogether. Okay, so liability, just add together this amount. Yeah? So at the end, you have this one. So all this amount here going to be transferred to your segment of financial positions. Yeah? Okay. Then going to look at here, the income segment. So profit after tax minus a tax, the profit before tax minus tax. And then profit for the year 45, from the 45, 40 to parents, and then another 5 to NCI. Okay, so this information come from your worksheet. Yeah, worksheet. Okay, the same thing that you have for segments of financial position. Investment becomes 0 because you already eliminate this one. Okay, other asset and then shares capitals based on this information also come from your worksheet. Yeah? Okay, so any questions that you have for these examples before we move to the intra-group transaction, which is more complicated. Say. Okay, do you have any question relate with this one? Any of you have a question relate with these examples here? Any of you? So I think that there is 35 there, members. Do you have any questions? Any of you? Before we
Clear
proceed
now,
to...
Doctor.
Sorry, okay, clear about this one?
Okay, clear, Doctor.
Okay, so the procedures here, we have 4 procedure. The first one, credit the eliminate the COI. That one is for parent. Every time you want to prepare the consolidated financial statement, you need to prepare the same journal entry for the parent. Because once you eliminate the COI, the amount should be at acquisition date. The second one is intergroup. We're going to look at after this. And then the third one is the NCI. So NCI is entitled for the profit after the acquisitions. Okay, anything that happened, profit and also others reserve after the acquisition, entitled both parent and NCI are entitled for that reserve. Okay, changes in the reserve. Yeah. Okay. So we move to the next one. Yeah, going to look at the intra-group transactions. Okay, suppose this one will be number 2 on the intra-group transactions. Yeah. Okay, so for intra-group transactions here is transactions that are done between parent and subsidiaries. Parent and its subsidiary may trade within the groups. In the group viewpoint, all the intra-group transactions have to be eliminated. So we're going to eliminate all the intra-group transaction because we assume that the group here is a single entity. So that why we need to eliminate. Based on logic here, the group can possibly trade or make profit among themselves. There is no profit among parents and subsidiaries as a group. Any intra-group transaction will be eliminated when the consolidated financial statement are prepared. Okay, when we prepare the consolidated financial statement, because the group must represent as a single entity. This one, the purpose of eliminations also can avoid the double counting of the assets, liability, revenue, and expense. Okay, at the same time, the elimination is also going to remove gain or loss that have been recognized in parents and subsidiary transactions. So we're going to remove any gain or loss. So for the intra-group transactions here, it is said that for the intra, MFRS 10 mentions that intergroup balance an intergroup transaction, a result of the unrealized profit should be eliminated in full. Remember that for the intra-group, okay, we need to eliminate balance plus transaction and also the unrealized profit. Unrealized profit. URP here is unrealized profit. Okay, intra-group losses may indicate an impairment that require recognition in a consolidated financial statement. Okay, for the elimination of transaction is only for the purpose of preparing consolidated financial statement. Thus, it will not affect the parent subsidiary books. Means that in the groups here, okay, for to prepare, you're going to prepare two things, group and company. For the group purpose, we're going to eliminate. Okay, but for the company itself, it does not affect. It will not affect the books of the company. Yeah? Elimination only for the purpose of preparing a consolidated financial statements. Yeah? Okay. So for the intra-group transactions here, okay, we have four types here. Four types. The first one is related with the intra-group sales of trading inventory. Okay. The second one here is intra-group sales of fixed asset. So for fixed asset, we have two types here, depreciable and non-depreciable. Okay, this one is more complex as compared with this one. This one also a little bit complex here. Intra-group dividends, okay, and then others intra-group transactions. So altogether, we're going to have four types of intra-group transaction. The first one is relate with the inventory. Second one here is asset. Okay, fixed asset inventory means that this one is a short-term asset. Short-term asset. Okay, this one is fixed asset, which is depreciable and non-depreciable. And then the other one, we have a dividend and others intra-group transaction. Okay, so we're going to look at the first one when there is a case of intra-group sales of inventory. Yeah. Okay, so just want to close this one for a while. Okay, for the sales of inventory can be transferred either at cost or at a selling price. Okay, inventories here can be sales at cost or at a selling price. Where inventory are transferred at cost, okay, means that there is no intra-group profit or loss. Okay, can possibly arise as the inventory only has been transferred from one location to another location within the group as a single entity. So once you sold the inventories here, either you sold at cost. When you sold at cost means that there is no profit or loss here. So this one is only move the inventory from maybe from subsidiary to parent or to parent from subsidiary. Yeah, you only move that inventory is related with the location, moving from one location to another location. Okay, the second one is when you sell the inventory, okay, at selling price. When you sell the selling price here, means that the cost is higher than the value of the selling price is higher than the cost, is going to have the unrealized profit. You're going to have the unrealized profit. Yeah? Profit that we cannot realize because this one is only a transaction between parent and subsidiaries. Okay, we have two situations that relate with the unrealized profit here. Okay, the first situation here, the buyer managed to sell the inventory during the year. So we have two parties here, parent and subsidiary. Let's say parent sell is source good to subsidiary. So parent is a seller and the subsidiary is a buyer. So let's say the buyer managed to sell. So the buyer sell it to outsiders. Sell to outsider in a year. Okay, so once there is sell it to the outsider in the year, during the year, so means that there is no unrealized profit. Okay, the second situation here, the buyer still hold, still hold the inventory until the end of the year. So you're going to have the unrealized profit here. This unrealized profit need to eliminate. Okay, so this is the problems that we have here. If the buyer cannot sell the inventory during the year, then they're going to recognize for the unrealized profit. That unrealized profit need to be eliminated. So in the case when we have ending inventory, we still have ending inventory in our books. Okay, before that, before we calculate the determine the journal entries here, we need to calculate the unrealized profit. There are two methods to calculate for the unrealized profit. The unrealized profit is exists in the ending inventory, because we unable to sell the inventory, so that in the inventory there is elements of unrealized profit. Yeah? So there are two methods to calculate for this unrealized profit. The first method is based on the above cost. Inventory was transferred above cost. So once inventory is transferred above cost here, the cost here will be 100%. So to find the sales here is the cost plus profit. So let's say the inventory was sold 20% above cost. So 20% above cost, the cost is considered as 100%. Profit here is 20%. So the total sales here will be 120%. So the URP here is calculated based on the percentage here. URP percentage of above cost, okay, divided by selling price. So the percentage that you have here is 20%. The selling price here is 120, and then time with intra-group ending inventory. What will be the ending inventory? So this URP here, the percentage here, if you have above cost, then you find that the rates here will be 16.67 here. 20 divided by 120. So this is the first method. Okay, URP is calculate above cost. Okay, the second method here is once the inventory is transferred at a selling price. So selling price here become 100%. Okay, so the profit is already given 20%. It should be 100%. So means that the cost here is 80%. So to calculate the URP here, the profit that we have here, so percentage of profit divided by selling price. Okay, selling price. So the profit that you have here is 20%. And then the selling price here is 100%. So you're going to have here is 20%. Yeah, 20% time with the intra-group ending inventory set. So we'll remember that two methods. Okay, if you're using methods above cost, so you need to consider that the cost will be 100%. If the inventory is at selling price, the selling price here will be 100%. The formula for the sales here is equal to the cost plus profit. So you are using this formula. Whether this one is 100% or this one is 100%, look at the wording that they are using here. Inventory transfer above cost, cost become 100%. Inventory transfer at a selling price become 100%. So be careful with these two methods to calculate for the URP, unrealized profit. Okay, unrealized profit only exists when there is a inventory which is unable to sell at the end of the year. Okay. So any questions that you have for this one? Okay, if there is no question, we try to look at example 3. Maybe after this you have a questions. Okay, so we try to look at example 3. Okay, for example 3, CD acquired AB in the year 2014 at the, with a 80% interest. Okay, C and AB, 80%. Okay, during financial year 2016, means that in the year 2016, mean that after the acquisition, A sold. Okay, A sold inventory to CD. So A is a subsidiary, so to CD at a transfer price amounted of 20,000. So transfer price when 20, this is the sales. The amount of sales here is 20,000. At the year end, 5,000 remain in the CD ending inventory. Okay, buyer still have the inventory, still have inventory here, still have inventory here. Okay, so the amount of inventory here is 5,000. So 5,000. The profit margin was 20% of the selling price. So the selling price become 100%. So 20 divided by 100. So you're going to have here is 20%. The 20% here will be the URP rates. URP rates. 20%. Yeah? Okay, to calculate the URP, okay, the rates of URP rate based on this one, time with ending inventory. Okay, so for the year 2016, URP rate will recalculate here 20%, and then time with the ending inventory for the year is 5,000. So the URP in the year 2016 here will be 1,000. Okay. Now we look at the year 2017. For the year 2017, you have sales of 30,000. So this is a sale, 30,000. And then 4,000 remain. Okay, so 4,000 remain, 20% time with 4,000. So we're going to have here is 8,000. So 8,000 here is the URP in the year 2017. Yeah, 2017. Okay, now in the year 2017, so this one in the year 2018, 1,000 here is URP brought forward. Brought forward means that the beginning balance because now we are in the year 2017. The 800 here is the URP carry forward, the ending balance. Okay, because it's in a currency. Okay. So this from these informations, we're going to prepare the journal entries. Journal entry for the year 2016 and year 2016. We need to record all the journal and the transaction. We need to record for the journal entries here. We need to record for the transaction and also the URP. So transaction that we have here is a sales only. Okay. So we're going to recap. One is for the transaction. The second one is for the URP. So only one transaction that we have here, which is the sales. Okay. So we're going to look at the journal entry that we have here. Okay, the first one, we're going to eliminate the intra-group sales. Intra-group sales here, remember that? We're going to debit, cash, and then credit sale. So this is the first one that you have journal entry 20, for example, 20. Now we're going to eliminate here, means that you need to debit this sale. Okay, going to debit this sale. Because eliminate means that you want to reverse the journal entry or you want to delete the journal entry, write off that journal entry. So this is the first journal entry. Now after that, we're going to eliminate here. So why we want to eliminate? Because we want to prepare a consolidated. So because you assume that parent and parent and subsidiary is a single entity. So we're going to eliminate this one. So we're going to debit sales because previously you credit. Now we need to debit sales and then credit cost of sale. Normally we are using this one. We're not going to use this one. We're going to use cost of sale. So debit 20,000 sales, credit 20,000. This one is to record for the transaction. Remember that two things that we need to do, record for the transaction. The second one is record for the URP. Okay, for the URP here, because the URP exists in the ending inventory, so you're going to debit cost of sales. Cost of sale, this one is statements of P&L, profit and loss. Okay, and then credit that inventory. Inventory is in the statements of financial position. Why we need to credit this inventory in segment of financial position? Because in the elements of inventory 5,000 here, there is 1,000 of element URP. Okay, another 4,000 here is elements of inventory. So we need to reduce the amount of the URP. So that's why we're going to credit inventory in segments of financial position and debit COS 1,000 here. Okay. I just proceed with the year 2017. If you have any question after this. Okay, for the year 2017, okay, you may have a new one. Okay, so this is the first journal entry to eliminate for the intra-group sales. So you're going to debit sales in the year 2017. Sales here is 30,000. Sales 30,000. So debit sale, credit cost of sale 30,000. Okay, the second one. Okay, I love the second one first. We go for the third one. The third one here is there is URP in the ending inventory because in the year 2017, you still have a balance of 4,000 in the ending inventory. So from that 4,000, you need to time with 20% to find the elements of URP. So the URP that we have here is 800. So debit COS and then credit inventory segments of financial position. Okay, this is like the one that you have in the year 2016, the first journal entry and then the third journal entry. Okay, this is a new one. Okay, this is a new one. The years here. Okay, what is said here? reinstate URP brought forward, and to account for the realizations of profit deferred in a prior year. So in the year 2016, you have unrealized profit. Okay, when it comes to the year 2017, this unrealized profit of 1,000 here become a realized profit. Realized profit. Okay, because this one is a short term, short term. So 1 year it's going to be realized. So once you're going to realize here, going to transfer this one to your returns, and because once it's realized, it become your profit. Remember that this profit going to be transferred to the returns and then yeah. So that's why when it come to year 2017, the next year, you need to recognize for the profit that you realize. Okay, recognize it. Recognize profit. Recognize profit that has been realized. Okay, so you're going to debit a returns profit. Why debit? Because you want to eliminate debit a return profit and then credit the COS, cost of sales. COS here is a cost of sales. Okay, so this one is to recognize the realizations of profit in a prior year, the year 2016 profit. When it come to the year 2017, we can realize that amount or recognize that amount. So debit RE, credit COS. Okay, so any questions that you have for this exam, please? Because after this, there is a lot of transactions related with the parents and subsidiary. Any questions that you have for example 3? Any of you have a question for example 3? Please have a look on that one if you have any questions. The first thing you need to know how to calculate the URP. URP has two formula, over cost or over selling price. Okay. And then do URP exist in if there is still a balance in the ending inventory? So we need to eliminate the URP, unrealized profit. Yeah? Any question, please? For example 3, any of you have a question here? Any of you questions that you have there? To understand this one, example 3, please, because you need to understand this one. After this, there is a lot of transaction related with the intra-groups transactions. Yeah? Any of you? Okay, no questions, huh? Are you still there?
Yes, doctor. Now clear.
Okay, for now it's clear. Okay, so we proceed. Okay, so we're going to proceed with the next one. So, going to look at the okay, we have two types of sales. We have upstream sale and downstream sales. Okay, intragroup sales of inventory can either be upstream sales or downstream. Upstream sale means that the subsidiary sold the inventory to parent, like example 3, the one that you have for example 3. Okay, downstream sales here is the parent sold the inventory to the subsidiary. Okay, so it be the other way. Parent sold to the subsidiary. It is important to determine the relationship as the accounting treatment will be different. So the accounting treatment for upstream and downstream here will be different. Okay. You need to know whether parent sold or subsidiary sold. Okay, we try to look at the upstream sales here. Okay, for the profit from the intragroup sales will be for the upstream sales. Okay, will be recorded by the subsidiary. So once, okay, we have a parent and subsidiaries here. Subsidiary, one subsidiary sold to parents considered as an upstream sale. So the subsidiary here is a seller. Okay, and then the parents here become a buyer. So once seller sells goods to buyer, they're going to recognize a profit. Going to recognize a profit. Okay, so when the full unrealized profit are eliminated, the shares of profit of for the non-controlling interest must be allocated based on the percentage of the subsidiary. So once the seller, okay, seller sells to the buyer, they're going to recognize the profit. Remember that the profit here going to be allocated among parent and subsidiary. Okay, the same thing for the unrealized profit. It's happened the same thing for the unrealized profit. So that one we're going to be eliminated first. So once you have the URP, unrealized profit, you're going to eliminate. Okay, and then after that, we're going to have a profit, a real profit that we can distribute between parent and subsidiaries. Okay, parents and NCI. So they said that when the full unrealized profit are limited, the shares of profit for NCI interest must be allocated based on the percentage in the subsidiaries. Okay, to calculate for the shares of profit for the NCI shares of profit here, we're going to use this formula. Okay, percentage of NCI time with subsidiary profit, net profit, plus URP brought forward and minus URP carry forward. Beginning balance, URP beginning balance, this one is ending balance. Okay, this is we're going to calculate the shares of NCI interest in profit, shares of profit. So percentage of NCI time with a subsidiary profit after tax plus URP brought forward minus URP carry forward. So in this example, URP in the year 2016, we need to plus and then minus URP in the year 2017. Yeah? Okay. And then the second types here, the NCI shares of RE, should also be calculated as follow. The NCI in the selling percentage of NCI, NCI time with subsidiary return profit, brought forward minus URP brought forward. Okay, so this is a formula. You need to know this formula. For the shares of returns profit, this is how to calculate. Okay, the return profit brought forward minus unrealized profit brought forward. Yeah? Okay, so this is what you have to calculate this returns earning. Yeah? We are using this formula. So we try to look at example 4. Example 4. So this is what we have. Based on example 3, assume that the transaction during year 2017 were as follow. The profit after tax is 60,000. Return profit balance here is 120. Sale to CD here is 30,000. So CD here is a parent here. Okay, this is a subsidiaries. Ending inventory in CD here is 4,000. So this one is year 2017, which is a current year. Previous year 2016. Okay, you have a sales here is 20,000. Ending inventory here is 5,000. Okay, now we're going to calculate the share of NCI in the URP. URP in the segments of profit or loss and the segments of financial positions. Okay, if you will look at here, the URP here is 20%. Yeah, so URP for the year 2017 will be 800, and the URP in the year 2016 here is 1,000. Okay, this one a time with 20%. So this is URP brought forward. Okay, because it's come from year 2016 now in the year 2017. So this is your URP carry forward. You need to determine this one because later on we're going to apply to the formulas that you have here. Okay, brought forward here means that from a previous year. Carry forward here means that in the current year. Yeah? Okay. So now we're going to calculate the URP. URP, okay, we already calculate this one. 800. Okay, NCI in the statements of profit or loss. Remember the formula, percentage of NCI. Okay, time with profit of subsidiary plus URP beginning balance. Okay, brought forward minus URP carry forward. Okay, so this is a profit. This is URP brought forward, and then this is URP carried forward. Yeah? So 20% time with 61 minus here will be 60 to 100. So 60 to 100. So the amount shares of profit here will be 12,040. So NCI from profit or loss to debit and then credit NCI from the segments of financial position based on these figures. Okay. Now we're going to calculate for the RE. So the RE here, the URP brought forward here is 1,000 because remember that the formula that we use here, percentage of NCI time with subsidiary RE, RE subsidiary minus URP brought forward. Okay, so this is RE, returns earning balance for subsidiaries here is 120. This is RE, and then 1,000 here is URP brought forward. Okay, we're going to have 23,800. So this one would be the amounts here. Okay. That one is related with the upstream sales. Any question that you have for the upstream sale? For the upstream sales here, because the subsidiary is a seller, so once a subsidiary is a seller, they're going to recognize a profit, and also the in that seller book, they also have the profit and also have the URP. So because the seller is a subsidiary, the profit and the URP in a subsidiary need to be allocated among parent and NCI. Yeah? So this is approach how we're going to calculate for the NCI. So for the NCI here is percentage of NCI time with a current year profit in the subsidiary plus the unrealized profit brought forward minus unrealized profit carried forward. That one is a percentage of profit. For the RE, to calculate for the RE, percentage of the NCI time with the RE balance minus the unrealized profit brought forward. Yeah. Okay. So any question for these examples? Any of you have a question here? Any questions that you have here? Upstream sales is more complicated as compared to the downstream sale because downstream sale here is a sale from parents to subsidiary. So for a downstream sales here, parents sales to subsidiary. So once parents sales to subsidiaries here, parents going to recognize a profit together with the URP. So this profit and URP does not affect the NCI. Okay, does not affect the NCI. So when the fully unrealized profit are eliminated, the shares of profit for non-contract based interest will not be affected because this is a sale between parent and subsidiary. Parents go will recognize profit and the URP, so does not affect the NCI because NCI do not have a shares in parent. NCI only have a share in subsidiaries. Okay. Later on in example 4A, they'll give you the example for both the downstream and upstream sale. Okay, I just want to go through a few slides with you. Another 3 slides, the same example, but this time we have the effect of tax. Okay, if adjustment of URP has a tax effect, deferred tax liability should assets or liability should be recognized. Okay, for in the year 1, in the current year, you need to add additional consideration adjustment, means that you have another journal entries. First one is for the year 1, you're going to debit a deferred tax. In the case when you have the URP, going to debit the deferred tax and then credit the tax expense. Okay, this one is in the case when you have a profit. In the case when you have a loss here, you're going to debit deferred tax expense and then credit deferred tax liability. Yeah? So this is the journal entries. Yeah? Okay. So we try to look at the example that we have previously, the same journal entry that we have here, but we need to have new journal entries here. In the year 1. You refer back to the year 1. Yeah? If you look at the year 1, this will be the journal entry. So the year 1 here, year 2016. Yeah? Okay, look at here. The journal entry, the same journal entry that we have here previously, sales and then COS. The second one is to record for the sales. This one, the second one is for the URP, the same journal entry, but we have an extra journal entry here to record for tax. Okay, since you have the URP here, so you have a profit here, you're going to debit your deferred tax and then credit tax expense. Okay, so deferred tax here is statements of financial position, tax expense is a profit or loss. The amount of URP here, URP, okay, time with a tax rate. Okay, so going to have here 300 for a deferred tax. Okay. Okay, look at the second year. Okay, second year a little bit different. Yeah? Look at the second year. Okay, the second year, this is the same that you have here. Okay, this is the same as the year 2016. Okay, ending inventory to recognize the URP, to eliminate the URP here. Okay, ending inventory, PNL, this one is financial position 800, and then deferred tax, and then tax expense. Based on here, 800 times with 0.3, yeah, 30%. Okay, look at here. This is a difference. Okay, this one is to record for the realized profit. Okay, when you realize a profit here, this realized profit is subject to tax expense. Yeah? Okay, so the amount of realized profit here is 1,000. From 1,000 here is 30% going to be recognized as a tax expense. Okay, so from here, we're going to have 300 here. So remaining for your RE here will be 700. Previously, your RE here is 1,000, yeah? And then credit beginning inventory 1,000. But now, with the effect of tax here, the RE that we recognize here is only 700. The tax expense here will be 300. Why we need to debit the tax expense here? Because the profits has been realized. Okay, the profit of is realized, so it's subject to tax expense. Okay. So this is what we have for the effect of a tax. Okay, so I'm not going to proceed with example 4a. Just want you to study for example 4a. Try to differentiate between upstream and downstream. So for the next class, we're going to continue with example 4a and then the rest. Okay, we're going to look at the other transaction, intra-group transactions here, which is related with the depreciable asset, dividend, and so on. Okay, I'm still around. I still be here until 11:30. For those who have a question, they say I'm still here until the end of the class. But for those who think that they do not have a question and they want to leave the meeting, you can leave the meeting. So I'm still be around for those who want to ask for a question. So relate with your example 3. Any example 3, 1, 2, 3, 4. Okay. Any of you have a question? Okay. Any of you have a question, sir? So the thing become more complicated now, eh? Eh? Especially when you have upstream sales. Upstream sales means that the effect, the one is affect the subsidiary, you're going to affect the NCI also. Okay, so any questions? I'm here around until 11:30. If you have any question, please. Any of you have a questions? There are 35 of you. No question from 35 of you. So far, no question. The rest? What about the rest? How many is there? Any of you have a question? Lee, do you have a question, Lee? Okay, you need to do revisions. So far, understand. Okay, you go through. Try to look at example 4. Then you are going to understand whether you can understand on that one or not. So the things that we learned today is about intra-group transactions. So intra-group, we focus on the how we're going to allocate the profit in subsidiaries to the NCI and also to parents. Okay. So I'm still here if you have any questions. No questions.
No question, Doctor.
Okay, so if there is no question, for those who want to leave the meeting, can leave the meetings now. Okay, and then I'm still here for those who have a questions. Yeah. Any of you still want to scan for the attendance? Okay, I just stop sharing this one, yeah, for those who want to scan for the attendance.
Thank you, Doctor.
Okay.
Have a nice day.
Okay. Bear, you don't have any questions today, Bear?
Need to do revision first.
Okay, so we have four guys. Wait. Can I look at what is the ask about? Okay, we need to credit inventory for 1,000. Is it because 5,000 include? Okay, the inventory that we credit 1,000 here because of the elements of the URP, unrealized profit. Okay, because that unrealized profit here is a profit that exists between parent and subsidiary. So we need to eliminate that one. Yeah. Okay. We credit inventory because we want to reduce the amount of inventory. In that inventory 5,000, there is elements 1,000 of the unrealized profit. So that's why we need to eliminate that unrealized profit. It not means that we eliminate the inventory. We eliminate the elements of URP in that inventory. Why there is a URP in the inventory? Because the inventory is not yet sold until the end of the year. Is it okay, Pua? Pua? Is it okay? Ah, okay. For those who want to have a question, I'll still be around. Okay, if you don't have anything, so see you for the next class.